DeFi, or decentralized finance, is fast becoming an alternative to traditional finance. Built for the internet age, DeFi products open up financial services to anyone with an internet connection, and there are no centralized authorities who can block payments or deny you access. But is it just a passing trend, or is it here to stay? While the jury is still out on DeFi, we will break down the fundamentals of this disruptive technology for you in this video. So let's get started. Before that, a disclaimer. All of the information in this video is for educational purposes only and therefore should not be taken as financial advice. We encourage you to always do your own research. What is decentralized finance? DeFi is a way of accessing financial services enabled by decentralized blockchain technology. Instead of relying on a central authority or intermediaries like banks, brokers, lawyers, etc. In DeFi, integrity is guaranteed by smart contracts that self-execute under preset conditions. The contracts are powered by the blockchain, a public, neutral, and unalterable ledger that gives you control and visibility over your money. DeFi is accessible to anyone in the world, irrespective of location. You only need an internet connection. Imagining the world of DeFi. Decentralized finance, or DeFi, can be thought of as a digital village where members of the community interact with each other to exchange goods and services without the need for a centralized authority. In a traditional village, people would interact with each other to trade goods and services. For example, a farmer might trade crops with a blacksmith for tools. Similarly, in a DeFi village, people can interact with each other openly to provide financial services, exchange cryptocurrencies, and other digital assets without the need for an opaque central authority. Just as in a traditional village, trust is built within the community through reputation and social connections. In a DeFi village, trust is built and verified through transparent and auditable smart contracts that execute transactions automatically on the blockchain. The blockchain serves as an immutable, open ledger that is shared by all the people in the village. In summary, this decentralized system provides greater access to financial services, reduces costs, and increases transparency and security, making it more inclusive and empowering for individuals and communities. Services that were previously slow and at risk of human error are automatic and safer now because they're handled by code that anyone can inspect and scrutinize. By eliminating the involvement of intermediaries, DeFi allows you to be in complete control of your finances. In DeFi, your money becomes empowered. You can store it, lend it, trade it, convert it, and track it all in real time. Difference between centralized and decentralized finance. The main difference between centralized and decentralized finance is who controls the management and flow of your money. Centralized finance is the traditional finance system where banks, governments, or other centralized institutions control and manage the flow of money. In CeFi, users entrust their money to these centralized institutions who act as intermediaries and make decisions on their behalf. This also means that they can decide who they will lend to, the interest rates that they charge, and who they can deny their services. In the world of traditional finance, integrity depends on the conduct and resilience of the middleman, whether that is your banking institution, your broker, your lawyer, or anyone who quote-unquote guarantees a financial service for you. Examples of centralized finance include banks, credit card companies, and stock exchanges. Decentralized finance, on the other hand, is a system where the control and management of money is distributed among a network of participants. DeFi uses blockchain technology to create a transparent and open financial system that operates without intermediaries. DeFi allows users to interact directly with each other in a peer-to-peer fashion, without the need for a central authority. In DeFi, users have full control over their funds and can access financial services in a more secure and transparent manner. Think of it this way. Traditional finance is like a game of telephone, where your message gets passed along from person to person until it reaches its destination. With DeFi, it's more like a group chat, where you can talk directly to the other members of the group. The main building blocks of DeFi. The two key building blocks of DeFi are the blockchain and smart contracts. The blockchain. Blockchain is a digital ledger that records transactions in a secure and transparent manner. Each transaction is recorded in a block, and once the block is added to the chain, it cannot be altered or deleted. It is a public ledger shared by all computers on the network. Each block of information is linked to the previous block in the chain, which creates a blockchain. This creates a secure and immutable record of all transactions that have occurred on the network. Because the blockchain is distributed across a network of computers, it's very difficult for anyone to manipulate or alter the record of transactions. The use of blockchain technology in DeFi allows for greater transparency, security, and accessibility in financial transactions. Blockchains are especially useful for transactions that require a high degree of security, transparency, and decentralization, such as financial transactions, voting systems, or supply chain management. In the context of DeFi, blockchain technology is used to create smart contracts, which are self-executing agreements between parties. Smart contracts. Smart contracts is a term to describe computer code that automatically execute all or parts of an agreement and is stored on a blockchain-based platform. These contracts may stand alone as the only form of agreement between parties, or they may be used in conjunction with a traditional text-based contract to execute specific provisions such as transferring funds between parties. The code itself is replicated across multiple nodes of a blockchain. Each time a new block is added to the blockchain, the code is executed, provided that the parties have initiated a transaction that meets certain parameters. Smart contracts are usually written in programming languages that are specifically designed for computer programs, such as Solidity. For example, imagine you're buying a car from someone using a smart contract. You both agree on the terms of the sale, such as the price and the conditions of the car. You then write these terms into a smart contract, which is essentially a computer program that can automatically execute the terms of the agreement when the agreed conditions are met. Let's say that the condition of this smart contract is that the money will be transferred when the car is delivered to you. The transfer of money will only be executed when the car is delivered. These contracts can be used to automate a variety of transactions, such as payments, transfers of assets, or the exchange of goods and services. Once the conditions of the contract are met, the contract is executed and the transaction is completed. Benefits of decentralized finance over traditional finance. DeFi offers several benefits over traditional finance. First, accessibility. DeFi is accessible to anyone with an internet connection, regardless of their location or financial status. This makes it more inclusive and democratizes access to financial services. Second, security. DeFi is built on blockchain technology, which provides a high level of security and immutability. Transactions are recorded on a transparent, tamper-proof ledger, making it difficult for bad actors to manipulate the system. Third, transparency. DeFi is transparent, meaning that all transactions are publicly visible and auditable. This creates a high degree of trust between participants and reduces the risk of fraud. Fourth, decentralization. DeFi operates without intermediaries, making it more decentralized and resistant to censorship. This reduces the risk of single points of failure and increases the overall stability of the system. Fifth, programmability. DeFi protocols are programmable, meaning that they can be customized to meet the specific needs of users. This allows for creation of complex financial instruments and automated processes that can reduce costs and increase efficiency. How to get started with DeFi today. To access the world of DeFi and hold custody over your funds, you require an Ethereum wallet like MetaMask, Argent, or Ledger. The point is for users to have a private key, somewhat like the password to your email, and a public wallet address, like your email address. While you can share your public address, you never share the private key. This means that you can borrow, lend, trade, and invest in a completely decentralized, transparent, and secure manner without handing over your funds to a third party. This also means that no one can save you if you lose your keys, but that's for another time. Once you have a wallet, there are many types of decentralized finance applications. First, decentralized exchanges, or DEXs. These are platforms for trading cryptocurrencies and tokens, where users can buy and sell digital assets without the need for intermediaries like banks or brokers. Examples of popular DEXs include Uniswap and 1inch. Second, derivatives. DeFi derivatives serve the same purpose as traditional ones, hedging price risk and gaining exposure to the asset's value without actually owning the asset. The difference is that DeFi derivatives are smart contracts hosted on a blockchain, offering greater transparency and cost efficiency. DeFi exchanges offer derivatives trading in the form of options on platforms like Open and Hedgic, and margin trading on platforms like DYDX and GMX. Third, lending and borrowing platforms. These platforms allow users to lend or borrow cryptocurrencies and earn interest on their deposits. This is similar to traditional banking, but without the need for a central authority. Examples of DeFi lending protocols include Aave and Maker. Fourth, prediction markets. These platforms allow users to make predictions about the future outcome of events, such as sports matches or political elections. Users can place bets on the outcomes and earn rewards if their predictions are correct. Examples of prediction markets include Z Casino and Augur. Fifth, insurance platforms. These platforms allow users to buy insurance policies against specific events, such as the failure of a smart contract. Users can pay premiums to the platform and receive payouts if the insured event occurs. Examples of DeFi insurance platforms include Nexus Mutual and Cover Protocol. Sixth, stablecoins. These are cryptocurrencies that are pegged to the value of a stable asset, such as the US dollar or gold. They provide a stable store of value and can be used for on-chain transactions without the volatility of other cryptocurrencies. Examples of stablecoins include USDT, USDC, and DAI. Seventh, oracles. Blockchain oracles are entities that connect blockchains to external systems, allowing smart contracts to execute depending on real-world inputs and outputs. Oracles give the DeFi ecosystem a method to connect to existing legacy systems, data sources, and advanced calculations. Examples of oracle providers include Chainlink and Redstone. And that's all for DeFi 101. Hope you have a better sense of what could be the future of finance. We will be releasing more videos that dive deeper into the world of decentralized finance and also break down the walls of jargon that previously kept the average person locked out of Wall Street. We prefer building bridges instead. Thank you and see you next time.